From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. Tech under pressure, battered and bruised from doing business in China and with China. But the victory lap, it's gold. Record high. Countdown to the open in stocks kicks in 30 minutes.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, markets on edge ahead of Chairman Powell's key economic data. Target delivers a beat, while Apple and Tesla sales disappoint in China. And Super Tuesday gets underway with Trump on the cusp of the GOP nomination. We begin with a big issue. Hawkish Fed speak, setting the stage for Chair Jay Powell. Atlanta's Raphael Bostic expecting the first cut to be followed by a pause, saying, quote, this: given the uncertainty, I think there's some appeal to acting and then seeing how participants respond to that. I probably wouldn't anticipate back-to-back rate cuts. Mike McKee is with me now. Mike, this is about a redux of 1995, isn't it? Good morning.
Good morning. Well, it could be seen that way. It's an interesting position from the Atlanta Fed president, who has been dovish in the past, but now he's talking about maybe only one rate cut this year. And if that's the case, when do you do it? There's a question that will face Jay Powell up on Capitol Hill. Here's when they have meetings this year up until Election Day. The last one, November 7th, 2 days after Election Day. Do they wait that long? Do they do it in September, just before Election Day? There's going to be a lot of questions about whether the Fed is going to be politicizing rate cuts. So I've got a quote for you here. This is an American humorist, in case you haven't been familiar with Will Rogers, but he once said, in an election year, politics is applesauce. At that time, it meant nonsense. And here's Jay Powell saying, we don't consider politics in our decisions. We never do and never will. That's the answer you're likely to get. But the question then becomes, what will drive their decisions? And that's where Bostic comes in with a little bit of worry here. He's pointing out that the inventory levels around the country are very low. And you can see here the ISM manufacturing came in low this week and pretty much down where it was at the height of the pandemic. And we'll get the services number at 10 o'clock this morning, and that suggests businesses may want to rebuild their stocks, and that may mean a stronger economy rather than one that's pushing inflation down. Here's Bostic's quote on that. This threat of what I'll call pent-up exuberance is a new upside risk that I think bears scrutiny in coming months. As my staff and I have talked to business decision makers in recent weeks, the theme we've heard rings of expectant optimism. Did you notice that word, exuberance? Somebody else used that word. Was it back in 1995? Ooh.
Full circle. Mike McKee, well done. Mike McKee setting the stage from Mr. Bostic. Let's continue the conversation now with people at Money at Play in the markets. Invesco's Rob Waldner and Cara Murphy of Castra Investment Management. So here we are. This is 2 weeks apart. Jefferson talked about careful easing of 1995. Here we are, Bostic putting on the table or flying the kite, whatever way you want to phrase it, of one and done. Rob, good morning. What does careful mean, supplanting the word transitory?
Good morning. Good morning. So I think what we're hearing from Bostic is there's a lot of uncertainty in the markets right now because the recent data that we've gotten in January, I think, was quite noisy. We think there was a lot of seasonal issues in the labor market data, seasonal issues in the CPI data, in the retail sales data, because we have some new seasonals and a lot of volatility coming out of this post-pandemic period. So I think it's going to be important to see the next month or two. We're going to start to get this February data, look at the March data, see whether January was a bit of a fluke, because I think a lot of people have been sort of shading their views based on this January data, which we think there is some seasonality to. So to get to the point here, Mr. Bostic is looking for a rate cut and saying they may pause. I think we just need to see how the data evolves here. I think we'll get 3 cuts this year, probably 3 to 4 cuts, because the Fed has really delivered this soft landing, and why not cut rates in that kind of environment?
Well, yeah, but he warns against this exuberance. Good morning to you, Cara.
Morning.
So here we are. I put it to you, this is Bostic flying the kite ahead of Powell to deliver the cover that they need. If it was 1995 and it was one and done in the autumn, how does that play out for risk?
So I think what's very interesting in this whole story is that it's the Fed that's been super consistent in terms of what they're forecasting for Fed rate cuts. Late last year, we had the pivot party when the Fed started to incorporate 3 rate cuts this year. Market immediately started pricing in 5 to 6. Now they're back to 3 to 4. So yes, the Fed typically puts up these little trial balloons in the form of individual members commenting, speculating, talking a little bit more about their inner conversations. So I think this is the Fed sort of testing out the market. How will the market respond if the Fed is yet a little bit more even conservative in terms of when they start cutting rates? And I think the market is telling us that they don't care all that much. As long as there are some Fed rate cuts on the horizon, the market is feeling that the economy is resilient enough to be able to handle that.
But there is a consequence of that higher for longer, Cara, and you make it very clearly in terms of understanding the debt level in the broader market. Everybody's telling me reach for breadth, go, perhaps even go for value. Not perhaps the JP Morgan house, they still want to cling on desperately to growth. But contextualize the risk as we go forward in the Russell 2000 if we remain in this higher for longer.
So there are a number of different implications. And we've written about the fact that there are wide swaths of the economy that are actually very inoculated from higher rates. Think fixed rate mortgages or fixed debt on the corporate side. That said, you have areas where we've started to see that risk kind of filter in. Think credit card debt for consumers. Think high yield or small cap companies, as you mentioned, who are starting to face those higher interest rates. So the longer these rates stay higher, the wider that pain starts to become. So it's not that this economy is super resilient and can stay at this level forever, but it does mean that we have a little bit of room because the areas of the economy that are suffering with the higher rates are still fairly narrow. Now, that said, we think that there are some really interesting opportunities once you start to get out of some of those mega cap names because the market has been so concentrated there.
Yeah, and it has. And we'll come back to the froth concept in a moment from Kalanovic. But Rob, let me bring it back to you. I know that you put your stall out very clearly, and that's what makes a market. You're 3-4 cuts. The market's now shaving itself back. It's worried about the dots. You could get the dots taking us down to 2 cuts. How does that translate then to steepeners? Because what people are saying to me on the IB is that really challenges the ability to hold these steepeners going forward.
Well, the reason that you need to you'll get yield curve steepeners here is as the Fed rate cuts rates, we think that the long end of the curve is probably not going to move very much. So the longer term level of rates is probably not too far from where we are now over the next year or so. But so we're sort of approaching rates overall from a range trade. But if you start to, as the Fed cuts rates, and then as you start to price in more, you would get that short end coming down. So the key is it's hard to extend out in duration because of that negative carry that you get by extending out, and that's why we prefer to do steepeners looking at that short end of the curve.
Well, let's deal with Goldman Sachs versus JP Morgan and see what the two of you make of it, because we've got Mr. Kalanovic over at JP Morgan. He's talking about volatility and froth. Investors may be assuming that the increase in yields is reflective of economic acceleration, but earnings projections for 2024 are coming down, and the market appears too complacent in the cycle. Cara, are we too complacent? Is there a bit of froth building in this? And if so, where does complacency lie?
So I think we're starting to see a little bit of froth in the market, but nothing on the extreme. So, when we look at something like the AAII bearish sentiment, we're at lows that we saw in 2021. But other sort of technical measures, which are often a good indicator of froth in the market, are not really there. And then also when we look at some of the very concentrated areas of the market that have done well, they've been supported by stronger earnings forecasts, by, better operating margins. So So, at this point in the cycle, we typically see earnings expectations coming down a bit for the forward year. And that sort of decline doesn't look to be outside of our historic experience right now. So, a little bit of caution is warranted, and looking outside of some of those areas that have gotten a little bit exuberant, we might say. But we don't think the overall market is suffering from a great deal of froth.
Let me throw a bit of exuberance back at Rob. I mean, those credit spreads, I mean, who cares what I think of credit spreads? But I am curious to know if you think that good behavior and that tightness in credit spreads can endure. But of course, if you're going for 3-4 cuts, it will. I would take the other side of that trade. But is there exuberance in the credit market?
So I think the right way to think about this is in terms of the market narrative, which if you go back over the last 18 months, we've had several different market narratives that have developed. There was the recessionary at the beginning of last year, then there was the higher for longer. And I think the market has now settled on this U.S. economy grows very strongly for the rest of the year kind of narrative. Famously, we've had quite a few people coming on press recently talking about that kind of narrative, which is there's very few people looking for recession, very few people looking for that much slower growth. So I'm not trying to call it exuberance, but I would definitely say the narrative is very positive. So that creates a sort of downside risk for the market if things evolve in a different fashion. And, we just saw like the Atlanta GDP Now data, which has been indicated, which has been very good, is now looking for 2% growth in this quarter, which, that's we think we're in a kind of that sort of growth environment. So if you do get some downside from there, that would be, I'm not sure I'd call it exuberance, but the market is certainly priced for a very good outcome.
Okay, Kara, I'm drawn to I love the line in your report, which is you can buy prime rib for hamburger prices. I mean, that just makes me want to go out and sort of buy everything. So where can I get that kind of a deal?
Well, I mean, one of the more extreme examples of this is we touched on this a little bit in small caps. So you think about S&P and NASDAQ hitting new highs every day. The Russell 2000 is still 15% below its previous peak. And then when we compare valuations among those two sectors, you have large cap valuations typically run about 40% above small cap valuations. Today, they're running 100%. So as you think about, anytime you get out of that, whether it's the Magnificent Seven, the Fab Four, whatever you want to call it, you start to have much lower expectations, much lower valuation levels. Mm-hmm. I mean, another area is quality or value. There are a lot of these other factors that have kind of been left in the dust.
Okay, well, one that's not in the dust today, it's Target. We're going to talk about that in just a moment. Thank you very much. Stay with me. We've got more work to do. Rob Waldner and Cara Murphy. My guest this morning on markets. Let's look under the hood. As ever, 12 minutes into the show, Abigail Doolittle is with me on the Sector Watch. What have we got ahead of the opening bell?
Well, let's take a look at Target because those shares are popping sharply higher. This, of course, on a strong quarter where earnings beat by 27%. They put up nearly $3 in adjusted earnings, a stock up 9.3%. Sales were less than 1% better. So this really speaks to improved inventories. They have less of a need to mark down, and that should carry forward. So a little bit of a relief here on the expectation around negative comp sales. Tesla down another day, potentially down 2.8% right now after falling 7% yesterday, the worst day since the end of January, of course, and shipping a little more than 60,000 vehicles out of China. That was the lowest number in a year. And speaking of China, well, Apple continues to tumble. Its correction deepens, down 2.2% in this pre-market. iPhone sales down 24% in the first 6 weeks of the year. They slipped to fourth in terms of smartphone choices in China. And again, Apple is in a correction, even as you have the S&P 500 all-time high. Something to ponder, Manus.
Yeah, it's certainly taking a hit in terms of those iPhone sales and competition inside China as well as demand. Abby, thank you very much. Coming up on the show, all eyes are on Washington. Super Tuesday gets underway.
If you're holding up your M&A transaction or other kinds of, investments because you're waiting for a signal on November 6th, day after U.S. elections, better plan on a longer time horizon before there's resolution.
Donald Trump moving ever closer to locking in the GOP nomination. Super Tuesday in review on Bloomberg.
There have never been so many variables at play, both in terms of producing polling projections and weighting the variables, and the high likelihood of disputed outcomes at least dragging out a conclusion. So what I am saying is, if you're holding up your M&A transaction or other kinds of investments because you're waiting for a signal on November 6th, day after U.S. elections, better plan on a longer time horizon before there's resolution.
So it could be bumpy even after the election. Super Tuesday kicks in America today. Voters of 15 states are going to hit the polls, with the outcome expected to set up the November rematch between President Biden and Donald Trump. Bloomberg's Anne-Marie Horder joins me now with more. You've been waiting for this, Anne-Marie. You're going to have a busy 3 days and no sleep. Set the table for me. Good morning.
Well, today's less not so super Tuesday. It's kind of a snooze Tuesday because it's pretty much decided that it's going to be a rematch of 2020 between Trump and Biden. You have the Democratic Party that are going to be hitting up 15 states, as well as the Republican Party. But what we can look at this is potentially some nuances when it comes to the voting. Besides Missouri and Idaho, where that had their primaries for the Republican Party, what we saw with the former president is that he hasn't been able to break out of close to 70% when it comes to these primaries. So you can still see that there are individuals within the Republican Party who still want to go for a Nikki Haley type candidate. So how much work does Trump need to do when it comes to the general election? And then for Biden, Manus, the big question is going to be, how much is he going to get when it comes to an uncommitted vote? In Michigan, more than 100,000 voters came out. It was a protest vote. They said they want to see more when it comes to what is going on in Gaza, and they voted uncommitted. So you can see he potentially has more work to do, and what we'll see in the data overnight from Super Tuesday, more work to do when it comes to shoring up parts of his base before November.
Okay, Anne-Marie, thank you very much. Anne-Marie Horder, and good luck with the next couple of days at tracking the political narrative. Rob Waldner and Karen Murphy are my guests this morning. Whoever wins this next election, already in the run-up State of the Union, we understand we're going to be talking about tax increases. If former President Donald Trump takes to the helm next year, we could be looking at more debt from either presidents coming to the market. What is the biggest, most material risk, Rob, from a debt perspective in the next presidency?
Well, I think from a market's perspective, what we'd really like to see, we have this sort of rerun of the 2020 election. What we'd really like to see would be more of a split government, because from a debt perspective, generally, a split government spends less, creates fewer deficits than a government which is entirely controlled by one party. So that's, as we think about this election, that's kind of one of the things we're thinking about is it a split government or is it one party? And we have different outlooks based on those two things. So, right now the deficit is expected to run about 5 to 6% of GDP for the next several years. Mm-hmm. We certainly don't want to see that number going up. We have a primary deficit of close to 2% of GDP. We want to see that work down towards zero, not up from here. So if we got a significant tax cuts or we got a lot of spending, that would probably be a big problem for the fixed income markets.
And Kara, you do focus on this in terms of perhaps a bigger and more vexating issue for the bond market. We saw it play out once or twice in other global bond markets. People keep saying to me, Manus, we are miles away from any exogenous kind of shock as you had under Kwarteng and Truss in the United Kingdom. But you talk about the numbers, and they can be quite daunting, but this bond market seems fairly immune to them for now.
I think you're right. And I think this is the big issue that people are just not talking enough about. So for many years, I've had clients ask, what about the government debt? And for many years, it was the bond market has been allowing the U.S. government to borrow with impunity, right? We've been able to have extraordinarily low rates. And despite the fact that the debt relative to GDP was at historic highs, our debt service payments were at historic lows. So during that time period of low interest rates, it was fine. Today, it's not so fine. Interest rates have gone up significantly. Borrowing costs for the U.S. government have risen significantly. Now you throw on a presidential election in a year when we need to refinance about 30% of all U.S. government debt. That doesn't even include new debt. And then, by the way, voters don't fully understand that the U.S. government has very little ability to change its spending. I know here we're talking about potentially tax cuts or increased spending, but even the ability to sort of cut spending from where we are today is very, very limited. So this is a really big challenge if interest rates stay where they are.
And if they stay where they are, Rob, I just want to close off with this. The dollar has had a phenomenal outperformance predicated on a number of factors. One is the uniqueness of the US's strength and economic strength, but also in the shaving back of the rate cut narrative to 3, which is where you're at in the money. Does that cyclical dollar strength endure? Is the dollar a hedge going into a political vortex, one could say, towards the back end of the year?
Well, I think that the dollar strength is going to key off of the Fed. So if we get the Fed to really ease more aggressively than kind of we're expecting, which would be more than 3 cuts or so, you would definitely see the dollar coming off. Cyclically, the dollar is relatively strong. So we should be in a kind of environment where as the Fed cuts rates, if the U.S. economy is slow, that U.S. exceptionalism that you were talking about in the economy will kind of leak away a bit, and the rate, the carry in the dollar will come off a bit, and that should allow the dollar to come down.
Okay. Thank you very much, Rob. Thank you, Rob Waldner and Karen Murphy. My guest this morning on Super Tuesday. Coming up, we've got your morning calls. We've got Schwab's Omar Aguilar joins me around the opening bell. We're going to look ahead to Chair Powell's testimony and the key U.S. economic data. That conversation right ahead on Bloomberg. Markets are more under pressure from the tech narrative rather than the spike in yields caused by Bostic yesterday. Just take a look at Tesla at the bottom of your screen now, down nearly 3%. In 2 days, if it carries through, you're going to be down 10% on Tesla. And that is to do with China woes, China sales, and a closure of their factory in Germany. Stocks are set for a lower opening. We're going to test the mettle of the growth to value narrative as we look at these bond yields in a higher for longer narrative. Some of the scribes from Wall Street give you these notes to chew on. Wolf Research upgrades AT&T to outperform, highlighting an improving capital structure and an attractive valuation. Next up, Loop Capital downgrades Williams-Sonoma to hold, recommending investors stay on the sidelines until there's a better entry point. And finally, Argus downgrades Philip Morris to hold, expecting a notable decline in tobacco usage due to rising prices and mounting health concerns. Coming up with me, we're going to talk about these markets, growth to value, Tesla, Apple, all the challenges and the headwinds in the tech space. We have Omar Aguilar, he joins me, on how consumers will start weighing the economy, the outlook in a higher for longer narrative right here on Bloomberg. On certain days, the news flow on technology in China and doing business with China labors on these markets, i.e. the news flow on Apple and their sales, Tesla and their sales and production. That is what's dragging these markets lower, not the mini pop that you had in yields yesterday. We're rolling over to the cash open. We're lower, but still holding above the important 5,100 level. NASDAQ is down, and the broader equity market now in the Russell down by 0.6% as the market grapples with higher for longer. We've changed up the complexion. Bitcoin, 67,649. The actual market capitalization of this cryptocurrency has hit 1.35 trillion. So we are looking at a momentum here in the crypto narrative and the risk-on narrative. Yields are coming down this morning. This is a post-Bostic retracement as Raphael Bostic floated the idea of one and done in the third quarter in terms of rate cuts. The market is coming back again, down by 6 basis points. And gold actually makes an all-time record high. That is just worth noting. It's rallied by $100 in the past 5 sessions. one stock to watch at the open, it is Target. The retailer topping its fourth quarter estimates thanks to improving inventories. Abigail Doolittle is with me. Abby, take it away with Target.
Well, the stock is reacting so well, I would say that investors have that old Target feeling this morning. The stock is having its best day since November of last year, up more than 10%, having a lot to do with those improved inventories. That meant that gross margins were nearly 300 bips or 3% better than what was expected, or than the estimate. And one analyst saying outperforming even by another percent. That flowed right through to the bottom line. They put up nearly $3 in adjusted earnings. That was 27% better. Sales roughly in line. So again, speaking to that inventory improvement, having less to do, having to worry less about marking down. They also were able to take care of shrink to some degree. Relative to what's been going on, so of course there was a low bar coming into this quarter, expectations of same-store sales down 4.5%. They beat that just slightly, down 4.4%, but we'll take it given the fact that over the last year, the shares of Target really underperforming to the peers. At this point, now flat, but into today over the last year down relative to Walmart up about 28% and the consumer discretionary space up about that much too. Now you have to wonder if they can continue this outperformance for margins and inventories. Manus, will Target have that big catch-up trade?
Okay, well, they're certainly flying high this morning. Abby, thank you very much. Let's turn our attention back to tech. We'll talk about it this morning. iPhone sales in China are falling 24% in the first 6 weeks of the year. And that drags the Apple stock lower again. Ed, it's a 1-2 punch for Apple this week between fines in the European Union and the pressure in China. Where is that pressure in China coming from?
Domestic handset makers and also an economy that seems to be showing more signs of pressure than perhaps we realize. This is data from Counterpoint Research, and it looks at the first 6 weeks of the year relative to the same period a year ago. So Apple's iPhone sales in China fell 24% in the first 6 weeks of the year relative to that same 6-week period in 2023. And what's interesting about it is that on the domestic handset pressure side, Huawei saw its sales grow 64% in that same 6-week period relative to a year ago. And so what you're seeing is shifting dynamics in market share. Apple now holds less than 16% of market share in the smartphone market in China, whereas Huawei, given the growth they saw at the start of the year, now has more than 16% of market share. And the reason I also bring up the strength of the economy is that overall handset sales shrunk, right? You look at all the different names, some grew, the majority saw shrinking sales in the first 6 weeks. The stock's down 2%. We're trading at our lowest level since October. Interestingly, this is one data point, right? It's the most read story on the Bloomberg terminal, most read story on .com. But the other narrative that's out there is just growing disappointment about a lack of an AI story. Tim Cook promised at the AGM February 28th that the AI story is coming. But a part of this, if you look at the comments from the sell side and other strategists, is they look at Samsung, which has talked so publicly about the generative AI capabilities of its latest handset, and they recognize the traction Samsung is getting with that. And they're basically pleading with Apple to say, give us something equivalent that they've not yet done. But yeah, stock down 2%, lowest level since October. And in China, which is, of course, Greater China, around a quarter of revenue, this is a really big problem.
Yeah, and those analysts really are taking against the stock at the moment. Yesterday, it was being removed from Evercore's tactical list, and the list goes on. And thank you very much. Great context around Apple's push lower this morning. Tesla, same story here. We've got extending declines. This as China shipments fall to the lowest level in more than a year. Isabel Lee is with us. Isabel, I suppose the debate will rage here as to what pressure Tesla is under to perhaps move out of Mag 7 to turn into the famous 5. Good morning.
Good morning. That's exactly right. And in China, it's proving to be a tougher narrative for Tesla. So it did sink to its lowest in more than a year. But that's because of a sales lull due to the lunar holiday and, of course, renewed price competition. We know that China is the world's biggest EV market, and shares are now down around 2.5%. Tesla shipped 60,365 vehicles from their China factory in February. That's the lowest in December 2022. That's a 16% drop month on month and 19% year on year. But this isn't really such a big cause of alarm because during holidays, especially the Lunar New Year holiday, which is the biggest holiday in China, millions go off to visit their friends and family. Sales are generally lower. And as we know, China's EV market is slowly slowing, which is why Tesla, in a bid to compete with its rivals, have been offering numerous strategies. This includes discounts on some paint colors and also offering subsidized insurance to really compete in the local market. And this is where things get tricky. We have price cuts by major manufacturers. So this is, again, in a bid to boost sales, prompting some customers to hold back on purchases. And that's according to China's Passenger Car Association. So something to think about there, Manus. It's kind of like a cycle. You wait for a discount, but then you don't buy because you hope that it'll grow, the prices will become lower. So definitely something to think about. For now, shares of Tesla are down 25% year to date, Manus.
Isabel, thank you very much. Yeah, it's like everybody out there waiting to jump into the property market. It might not do you to extend and wait. So, from EVs to semiconductors, US officials are telling AMD that AI chips meant for the Chinese market, they're just too powerful to sell there, at least without a license from the Commerce Department. It's a tough old one to sell, isn't it, Simone, to the Commerce Department?
Yeah, and it's been a tough path to navigate for AMD, as it has been with the likes of NVIDIA as well, as they try and get around that 2022 ban on selling their best AI chips to China. So sources telling Bloomberg, who was first to report this news, that AMD was looking to launch a version of its MI300 flagship chip called the MI309 that would have been compliant with these bans in China. But apparently Commerce Department now thinks that even this chip has too much juice. This mirrors what we've seen with NVIDIA, for example, which went out to the market with what it thought was a compliant chip. Then the Commerce Department said, actually, that's a little bit too exciting for us. They tried to further restrict that, and they've continued to face questions about whether the Commerce Department will allow them. The good news for AMD is that it's never really been quite as exposed to China as its competitor NVIDIA. And Bloomberg Intelligence writing this morning in a quick reaction, this isn't likely to impact near-term sales estimate for AMD or its 3.5 billion AI GPU outlook for 2024 because its main buyers are in North America. That said, this news is weighing on shares today, down 1.6%. But I think you back out the picture, you look gains of nearly 37% so far this year and 151% in the past year, Manus.
Pretty spectacular. Simone, thank you very much on the stocks this morning. My next guest is Schwab's Omar Aguilar, joining me to discuss this. We've just been through a litany of angst from Apple, AMD, and Tesla. This is a market that is disturbed about doing business in China and with China. Is it a healthy wake-up call at the moment that this is what you should fear in the tech market rather than incrementally higher yields?
Well, good morning. It's clearly the macro environment, tends to have a big role in the way that, markets behave. We have been, consistently focused on two things. What is the macro environment that allows these companies to perform and generate earnings? Mm-hmm. A lot of the companies that you mentioned, have been incredibly successful in generating significant amount of cash flow. But at some point, as you actually get to certain levels of market cap and certain levels of earnings, you basically end up having a road that is less linear than it used to be. I think a lot of the headwinds that they see from their business overseas, and particularly because of the disparity between the U.S. economy and the rest of the world, you can actually see how that eventually becomes a headwind for many of the companies that have business internationally. I think the situation in China in particular, where the economy, has a significant amount of impact on a lot of the technology companies that we have in the U.S., anything that happens macroeconomically in the Chinese economy tends to have a significant event of potential earnings for these companies.
And of course, today we've heard this reaffirmation from the National Convention in China that they're going to stick with the 5% target. Omar, I'm drawn to your descriptor there about the road ahead being less linear. And one of those obstacles on the less linear pathway is, of course, savings. And you make this point very clearly. Excess savings have fallen from just over $300 billion. To just over $300 billion, and that's down from $2 trillion in the summer of 2021. So you talk about this level of exhaustion in the 2 months ahead without wage growth, and this will slow down the economy in the second half of the year. Now, I've heard various people talk about this, the running out of COVID savings. What I want to get a sense from you is this going to be a slope of a slowdown, or are we going to face some kind of a cliff-like moment for the consumer?
Yeah, well, it is an interesting, dynamic because the consumer is also not just one big block, and it's sort of you can break the consumer landscape into 80% of the earners that tend to have a significant amount of really strong balance sheets that continue to have solid savings and continue to have significant amount of well-balanced consumption patterns to their savings, and that's critical because for them the amount of debt, the amount of consumption doesn't really affect their personal lives. On the other hand, we have 20% of the lower end of the consumers that have seen the significant impact of higher interest rates and the disparity between their consumption patterns and their wage growth, because their consumption has gone higher than the levels of earnings that they're getting. And that's where you're starting to see this stress. That's when you see a little bit more of the delays in credit card payments. That's when you're starting to see potential issues in car payments or potential delinquencies on some of their mortgage payments. So the good news for the U.S. economy, however, is that 80% of the consumers that are well balanced, they tend to have mortgages that are funded at a very low rates and they're locked in. And that's one of the reasons also why the housing market has been fairly stable, because there hasn't really been that much turnover. And the wealth effect for that part of the consumer is still, pretty robust.
I just wonder, when I look at the length of gains and runs higher that we've had, 16 of the last 18 weeks, we've seen these markets, U.S. equity markets, run higher. We haven't seen that since 1971. Is it too late to go for breadth? You advocate in this soft landing scenario that you want to go for small caps, value stocks, etc., real estate. It's never going to be too late. You either participate in this market with a medium to longer term view, but I just wonder, it is so breathlessly high at the moment. Are you waiting before you deploy? Are you incrementally joining in those sectors?
Yeah, we always advocate always look at the long-term horizon and think about, what would be, your long-term strategy, and not necessarily try to find that timing where you can actually get in or get out. In fact, we try to always advocate our clients to just try to find pockets of volatility where they can use to rebalance their strategies and get them closer to their long-term objectives. Now, one of the points that you made, which is clear, is that we have seen a significant amount of rally since the low in October of last year, and it's been roughly 25 to 26% of market rally since then. Now, if you recall, a majority of the gains in last year in 2023, and also the majority of the gains this year, have been heavily concentrated in a lot of those top 10 names in each one of these market indices. So in many cases, what that does is it opens the opportunity for other companies that actually catch up and contribute more. And that breadth of potential contribution is something that we all expecting to at some point change. What is important right now is that outside of the headlines of those indices that are heavily driven by a few names, it is to actually find the opportunities when valuations still look attractive and then can potentially bring you opportunities for investing.
Okay, Omar, thank you so much for being with me this morning. Omar Aguilar, my guest on the markets. Coming up, Apple takes a hit, quite literally, in China.
Huawei is coming back, and Apple is probably going to lose significant share in China.
It's the Chinese consumers' impact on Apple, next on Bloomberg.
If you look at Apple, really, it's a competition. It's mostly a competition issue. So Huawei is back in China. They were not able to do phones for quite a while because they couldn't access chips manufactured at TSMC anymore. Now they figured out a way to do chips domestically on mainland China. They are back, and Chinese consumers like to buy Huawei phones.
New data revealing that iPhone sales have fallen by 24% in the first 6 weeks of the year. It's a similar story for another market darling, Tesla. That's what we've been saying. China vehicle shipments plunging to the lowest level in over a year. Team coverage, deeper dive. Ed Ludlow and Craig Trudell join me now. Ed, if we've already talked about the fines that have been levied against Apple and about the drop in sales inside China, does this put more pressure on Cook to diversify the demand cycle into India and other emerging markets at lower price points away from China?
Well, it's an interesting argument because if you look at the data, overall China's handset market, smartphone markets sank. And those that did better, you could say, okay, well, Huawei had an enormous jump in market share. It is more competitively priced than an iPhone handset. But some of the more budget names also had very modest growth or saw a sales decline. Tim Cook and Apple have always talked about India as the kind of sleeping giant, growing middle class. I remember 10 years ago being in London with you. We would talk about this idea of a growing middle class in India being a sleeping giant. 10 years on, it hasn't really come to fruition, but you see Apple investing in physical stores in India, developing its online marketplace. The story with Apple is kind of idiosyncratic in the sense that they're facing three threats, right? The domestic pressure from those handset makers, a difficult economic environment in China, but also the downward pressure on the stock right now very much relating to a lack of story in AI. That really seems to be the anxiety of the street.
Well, let's see whether they manage to turn that around. I mean, there is more pressure on Cook than there has ever been. Craig, good morning. Good to see you. So here we are with Tesla. We know the incremental lashings that Tesla has had. Nancy Tengler was with the Bloomberg Brief team this morning, myself and Danny, and she said, we are misunderstanding what the depth of value is within Tesla. And that is, it is about the batteries, it's about the plants, and that must be remembered for the longer term valuation narrative. She bought it at 104, she sold it over 200, and she's tipping her toes back into this market at these prices on the dips. Can you help me understand why Tesla, we need to perhaps look a little bit deeper than the headline incentives that were being offered to buy one?
Well, I think Isabel hit it well before the break, talking about the idea that, we shouldn't overread into any 1 month's results in China, especially the month of February, the fact that you do have the Lunar New Year having an effect on the month. That being said, this was a pretty bleak result, and I do think that there is a sort of, overarching theme that we've been seeing for weeks and months of EV slowdown that's given people real pause. Some sort of unintended consequences of the effect of really slashing prices at Tesla and the effect that that's had on resale values. I think much as there's a lot to be said for the promise of Tesla, whether you want to look at it as an AI company, the fact that it brings a lot to the table outside of cars potentially in terms of battery player and energy storage, and a lot of buzz around the Megapack product. Self-driving development that Musk has talked a lot about it being the sort of long-term driver for Tesla. I think the market was much more willing to entertain those things in a zero interest rate environment because Musk himself will like to talk about the idea that we make the impossible merely late. That he's been able to accomplish an awful lot with this company, but it tends to take him more time than he says he needs. I think the fact that Tesla has had so much of an issue with delivering on a lot of his promises leads to this sort of bang on the head when you do see some operational issues like we've seen in China and like we've seen just in the last few weeks in terms of disruption to their production, even here in Europe and in Germany, which we're seeing again today.
Or is it that, as we mere mortals lack the imagination to comprehend flying taxis on Madison Avenue? Get the shopping done. Ed, thank you very much. I'll leave you with that thought on the West Coast. Craig Trudell in London. A little bit of breaking economic news coming across the Bloomberg terminal. Abigail Doolittle joins me with that. Abby, what have we got?
Indeed, we do have some of the final PMI, U.S. PMI data for the month of February coming in better than expected. For the S&P Global U.S. Services PMI, the actual was 52.3 versus the survey of 51.3, a little bit better than the prior. And for the composite, 52.5, also coming in better. This, of course, is in expansionary territory. Below 50 would be contraction. And we have the ISM services coming up today at 10 a.m. The estimate there is for 53, maybe setting up for those larger companies a little bit of strength there as well. Relative to sectors, Manus, we are looking at a 0.5% decline for the S&P 500. And it's that heavy tech weight, consumer discretionary and services indexes. Those are really weighing today on the S&P 500.
They are indeed. And tech is dragging us all into the bottom of this market. Coming up, market moving events for your day. We'll set up your trading diary. week ahead looks like this. Fed Chair of Supervision, Michael Barr, speaks this afternoon. Plus, all eyes on the polls, Super Tuesday. And then it's Chair Powell testifying on Capitol Hill on Wednesday and Thursday. Thursday night, President Biden will deliver the State of the Union address. And Friday, you got it, it is the jobs report. That was Countdown to the Open. Tech is under pressure. Apple is down 23% this year. And Tesla also under pressure, dragging these markets lower.